To the story now, the announcement made by Finance Minister eNCA at his budget speech to change the Pension Funds Act to allow insurance, retirement and savings funds to invest about 45% of assets offshore has largely been welcomed by asset managers, but they have flagged that there could be some negative and unintended consequences. We've got Sangeetha Sunath, who's the Deputy Managing Director at 91, who joins me now to talk more about this. Thank you very much for your time this evening. Before we get into those unintended consequences that have been written about throughout the day, maybe talk us through the value that the Minister's announcement unlocks for those who have funds.
Good evening, Rafiwa, and to the viewers. Thank you so much for having me. It was a fantastic pronunciation of the name. Not many people get it right. Yeah, look, I mean, so as you said, it's a hugely positive outcome for end investors and for retirees. I mean, the limit basically allows retirement fund investors who save for their retirement to increase their offshore allocation from 30% to 45%. And if you think about, you know, the potential opportunities that investors have on a global basis to invest. I mean, South Africa, you know, is less than 1% of global market indices or GDP, gross domestic product. So having that opportunity set increased improves the potential for returns for investors in the long term. So that's hugely positive for clients.
Right, but then there's the flip side, which is what's been reported on, in that there could be some negative implications on investment flows. In layman's terms, Sangeeth, what exactly does that mean?
Yeah, so look, I mean, as you say, on the flip side, there is potential that capital flows out the country because people allocate more to offshore than they do to local investments. So, you know, instead of buying a South African investment stock like a Clicks, for example, somebody decides to choose, you know, an offshore stock, Amazon or Apple or something to that effect, which means that the money leaves South Africa and moves globally. Now, when this announcement was made, you know, the rand actually weakened a little bit, but more recently you've seen a bit of strength on the rand. And so it depends on how these dynamics really play out. And we've been fortunate in South Africa, you know, relative to other emerging markets, relative to the benefits that we have with commodities in South Africa, that people have started to invest more in the South African economy from global perspectives. And so whilst the expectation is that probably 800 billion rand will leave the country in the next 3 to 5 years because of this change, there are other dynamics at play as well. But, you know, I think, Rafiwa, the important thing for viewers is that, you know, you need to consider what this means for you and your investments, because that's really the key question. And I think the key thing here is that it improves the potential returns, but you've got to make sure you choose the right provider to give you those additional returns going forward. So it talks to, you know, the value of choosing the right financial advisor who's got the experience. It talks to the value of choosing, you know, the right partner who manages your money, the right investment partner going forward. So there's a whole lot of considerations that you need to think about to make sure that you get the real value out of this.
No, absolutely. In your note earlier on, you indicated that this trend could go beyond the asset management sector. Talk us through that and really the other sectors it could have an impact on as well.
Yeah, so, you know, I think outside of the asset management, I mean, as we've spoken about already, you know, there's few corporates, companies in South Africa that will attract capital flows because of the benefits that they bring. And then there'll be a few corporates who will actually, you know, lose out because investors choose to invest in offshore companies rather than South African companies. So, you know, there's obviously corporate SA which will be affected by this. And then, you know, within the financial services space, there's going to be guys that adapt and businesses that adapt to these situations and businesses that don't. So, you know, take one area, for example, financial advisors. You know, those who adapt to be able to allocate offshore, to be able to choose investments offshore, will probably be winners long term. And the choice, you know, whereas in the past, the 30% was quite a scarce resource. You know, it was quite an important component to make sure you allocate to the right area. Most investors were able to choose global equities, and they were, you know, going to get the right returns choosing global equities. Going forward, you need to consider other asset classes. You need to consider global bonds. You need to consider emerging market equities. You need to consider emerging market debt. You need to consider real estate. There's a number of things that you need to think about. And so the financial advisor businesses that adapt to these situations, will win. And those that don't, and there will be some that don't, will potentially lose out of this. And so outside of corporate South Africa, there's financial advisors, there's the investment management firms, asset managers, there's the wealth management businesses, across the SA landscape that will be impacted by this. So there's a lot of different moving parts here, that need to work together, because it does feel, like this is quite a significant change for the South African industry.
Very, very interesting insights there. Thank you very much, Sangeeth Sunath. And I must be honest, I did ask a colleague of mine to help me pronounce your name earlier on today. So I'm glad that you noticed that I tried my best. Thank you very much for joining us this evening. He's the director at 91.